Well, good morning to you and welcome to the Global View. We take a look beyond our own shores in the ASX listed universe. I'm Nadine Blaney. Coming up, we have Steve Sosnick, from Interactive Brokers. So looking forward to that chat. Let me just get the basics out of the way so you know what we're dealing with. We had European and US markets really rallying on the prospect of that new Treasury Secretary, Scott Bessent. The S&P 500 and the Dow touched record highs before closing up. As you can see, we saw real estate leading the gainers in the S&P 500 up by 0.3%. We saw the Dow Jones Industrials, the best performer, up by close to a percentage point. And we had the Russell 2000 hitting yet another fresh record high. So computing stocks surged with Amazon's AWS launching Quantum Embark. It's a program which aims to get businesses ready for quantum computing. Now, Peabody Energy, that stock fell after it agreed to buy Australian coal assets from Anglo American in the Bowen Basin for a cash consideration of up to $3.78 billion. That's as Anglo is bolstering itself against a BHP potential second play. In earnings, Macy's shares dropped on a preliminary third quarter sales miss and an accounting issue. Bed Bath & Body Works gained on a lift to its annual profit guidance. Meantime, MicroStrategy shares rose after it bought more than 55,000 Bitcoin for $5.4 billion. And speaking of Bitcoin, it took a bit of a breather, slowing its run toward that $100,000 mark. And we'll be watching Block shares locally. Shares fell as much as 3.2% at one point after BMO downgraded the stock to market perform. Did, though, lift its price target to $100. BMO reckons it'll be tougher for Block to see gross profit upside from here without lifting the headcount cap. So President-elect Donald Trump named his choice for Treasury Secretary late on Friday. So Monday was the first full session for markets to react to the appointment. It's expected by some that Bessent could take measures to restrain further government borrowing. He himself told the Wall Street Journal over the weekend that both tax and spending cuts are priorities. On the data front, the Chicago Fed's National Activity Survey Index fell, coming in below expectations, but the Dallas Fed's Manufacturing Activity Survey rose to a 31-month high. In Europe, the German business sentiment read fell below expectations in November, mainly because of a weaker current conditions assessment. And markets cheered comments from the ECB's chief economist, Philip Lane, who said the central bank should not keep its monetary policy too tight for too long, or inflation could fall below target. U.S. Treasury yields declined sharply as investors expect that more moderate than feared U.S. fiscal trajectory on Scott Bessent's nomination to the Treasury. 10-year yields stood at 4.269, down from 4.1%. The U.S. dollar recoiled from its two-year highs, tracking those sharp declines in U.S. Treasury yields. And just a quick look at commodities overnight. Oil prices fell more than $2 per barrel after reports that Israel and Lebanon had agreed to the terms of a deal to end the Israel-Hezbollah conflict, citing officials from Israel, Lebanon, the U.S., and France. Gold prices fell sharply, breaking a five-session rally with safe haven flows abating. And that put pressure on gold stocks in the U.S. today and likely here as well. Goldfields and Harmony Gold under a lot of pressure. But copper rose 0.3% and iron ore was up 2.2% to $103 per ton. So let's make sense of all that now. Get some perspective with Steve Sosnick, who's joining us from Interactive Brokers. Steve, nice to see you. Thank you so much for joining us. That was a punchy move in Treasury yields to the downside.
Good morning, Nadine. Yeah, the Treasury market liked what it heard today, and that was that essentially one of Wall Street's own is in line to become Treasury Secretary. And investors like when investors are at the helm. They've basically, remember, we have Jerome Powell at the helm, who, although much was said that he was a lawyer by training when he took the role, he's an investor by profession. He was a senior executive at the investment firm, the Carlyle Group. Scott Bessent has a long career on Wall Street with his own hedge fund now, but he really came into prominence as one of George Soros's protégés, which actually is an interesting juxtaposition, considering that George Soros is sort of like a boogeyman of the right, and yet here he is serving under having served under George Soros in private sector. Now he'll be serving under Donald Trump in the public sector. That's quite a feat if he can pull that off. But this is what the bond market wanted to hear, and when the bond market speaks that loudly, even in a holiday shortened week, you have to listen.
Yeah, so what we're saying is Wall Street is feeling seen by this appointment to Treasury Secretary, likes that enthusiasm.
Yeah, basically. I think investors want to feel loved like everybody else, and this I guess accomplishes that to some extent. Well, there's a lot to be seen here. As with most political messaging, there's stuff in there that sounds wonderful on paper, probably not the easiest thing to achieve. He has a plan about a 3-3-3, which involves 3% GDP growth. Well, we're not that far off from that. We'll learn this week. Later, we'll learn on Wednesday whether, we're about 2.8%, so we're kind of there. 3% budget deficits, that might be an interesting challenge when we're running 6 or 7% budget deficits. It's nice to hear, but how you get there, um, and it is really a challenge because the ways that you get there might not necessarily be compatible with 3% GDP growth. And then we talk about, then he wants to basically drill, baby, drill, at a time where U.S. drilling is pretty much at the highest levels ever, and oil prices, as you just reported, are not exactly robust. So there's a lot of moving parts in there that may not all add up. But again, the bottom line is, I think the bond, there was some nervousness in the bond market about sort of rampant Treasury issue. And remember, this, as Secretary of the Treasury, he gets to set the policy on how the government raises its money and how the government finances its debts and deficits. And so, if you have a person who knows how to listen to markets in terms of how to best achieve that, there's some optimism that'll be achieved in as market friendly of a way as possible.
Now, something else about the bond market through the overnight period, we saw the inversion of the yield curve. We haven't obviously needed to talk about that for quite some time, about its harbinger of recession coming through. So, should we be reading a lot into that, Steve?
Not yet. It's still a little early. Remember, we disinverted, really normalized, I guess is probably the better word. We normalized on a lasting basis about 2 months ago, and it's not like we roared ahead into a normal term structure. We basically got 20 basis points at its peak on the 10-year over the 2 year. Today we slipped back into inversion. It was, more or less around -1 all day. It was kind of a push when the bond market kind of closed up today. Um, in theory, the inverted yield curve is a harbinger of recession, but it's tricky to interpret right now. Again, one day is not a trend, but it's telling us that, some, I guess today is a tough one because remember, the recession typically only starts after the yield curve disinverts. So it might be, the market's way of saying that we're not going into recession anytime soon. It also might be just more of a technical structure of, perhaps with a Bessent run treasury, you might have the mix in such a way that he won't be as dependent upon long-term borrowing as some of the longer end of the curve expects. So I'm gonna put it on back on the watch list, but not
Mm-hmm.
necessarily react too strongly to it right now.
Now, Steve, another feature of the overnight session was the Russell 2000 hitting yet another record high. So, is this an endorsement of what we anticipate coming from the Trump presidency, tax cuts and the like? Or is this again, part of an ongoing thematic of broadening out of this bull run because, it can't stay so concentrated in perpetuity?
The short answer is yes to both. I think at some level, I think the more overriding reason is just it's the rotation trade. The momentum in this market has been astounding. It's really been the factor that has driven the market higher for months now. And if you think about it in terms of investing factors, the various things that make stocks go up, momentum is definitely the one that is clearly in the lead. And so when you have a momentum driven market, it's typical for people to move towards sectors that have been performing less robustly than the others. It's hard to say underperforming in a meaningful way because, again, you just mentioned it's at an all-time high. Um, Now, throw in the fact that in theory, if you have a generally protectionist um, administration, one that might be protecting smaller businesses that don't have a lot of international pricing power and exposure. Well, that sort of biases you again toward a little bit towards small and mid cap. And if you have a situation where it's going to be easier to do mergers and acquisitions, well, smaller companies are easier to acquire than big ones. They don't cost as much, and there are a lot more of them. So perhaps that helps them out. The thing though that keeps me from being really excited about small caps is in the Russell 2000, you have uh, uh, hundreds of them that don't make money, that can't even necessarily service their debt at current levels. Quite frankly, a lot of the best small cap companies have already been picked over by private equity. So there's a bit of a negative survivorship bias there.
Hmm.
So what I'm going to say is, though, it's easy to move those stocks because they're small. They can be easily moved because the entire market capitalization of the Russell 2000 fits into Nvidia. Um, it doesn't take much to move these things. So when the money flows into small caps, it's always hard to fight the tape. It's especially hard to fight the tape in small caps when the money is flowing in that direction.
Yeah, well, this is why we call you for some perspective, Steve. Thank you. And perspective on the rest of the week. I mean, it's going to be a quiet one. We've got Thanksgiving on Thursday. We know that you guys absolutely love your Thanksgiving holidays. And then that's followed by Black Friday, of course. So, yeah, we've got some big data points this week, but safe to say it's going to peter off toward the end of the week.
Yeah, I think by Wednesday late morning, you're going to get people just checking the traffic reports rather
Yeah.
than the markets. Um, yeah, we have the holiday on Thursday, and then because the holiday's on Thursday, we have the weird half day on Friday. The reason for that is there's some act of Congress from the 30s that says you're not supposed to have the market closed for more than 72 hours in a row. So we trudge in all fat and hungover and,
Yeah.
and deal with that. But there's really no economic data that comes out. But we do make up for it because we do have Fed minutes coming out tomorrow, which should provide some insight into uh, the level of rate cut enthusiasm that the Fed has right now. We're in a sort of a weird position here where the Fed funds futures are actually expecting fewer rate cuts than the last dot plot, which we will get another one in a few weeks. But that's going to be a tell. I mentioned GDP coming out on Wednesday morning. 2.8% is the consensus. We also get some core PCE price numbers, which were 0.3% on a month over month basis is the consensus. Those are both unchanged from the prior readings, but any deviation from that can certainly change the narrative, especially in a thin holiday
Hmm.
shortened trading period.
Well, Steve, look, speaking of holidays, you sent us a couple of amazing pictures. I think we've got one to bring up on screen. Tell us, where were you?
Um, well, I know you're Canadian, Nadine, and this is a place I know that even a lot of Canadians don't get
Yeah.
to. It was northeastern Manitoba, a town called Churchill, which is, I don't know that Canada has an outback, but if it,
That's
it would
it.
be pretty much the same, except it's Arctic instead of desert. And this is a place where polar bears congregate, waiting for the ice to freeze on Hudson Bay, which is an inlet of the Arctic Ocean. And I've been planning this trip for decades, and I finally pulled the trigger. And man, are these things amazing animals. They come right up, they get close to you. You're protected from them. You're in these vehicles that have very hard, very high and have metal grates, but man, they look you in the eye and they're sizing you up. And the Inuit have a legend that polar bears are just people in white suits that go, they take off their suits and when they get into their dens, and man, you can see the humanity in these things. They are brilliant, but they will, if you know, they're immense predators, the largest land predator, and it really makes you think. And they're silent, which
Yeah.
it was an amazing trip. Thank you for
Oh,
sharing that.
yeah. Well, thank you for sharing. I just got shivers. Put it on the bucket list, Steve. Look, we love seeing you. Thank you. Have a wonderful, happy Thanksgiving. We wish you all the health and happiness to you and your family.
Thanks, Nadine.
Take care.
See you soon.
Steve Sosnick there from Interactive Brokers. What a trip, Churchill, Manitoba, and he's so right. You know, the Canadian Arctic is the equivalent of the Aussie outback. You got to be very careful where you go. All right, let's just get across what's happening here today. We've got some AGMs, Brickworks, Pilbara, Ramsay Healthcare, Gentrack out with earnings, Newmont trading ex-div. No real economic data on the horizon here locally. And we are expecting to see this local market lift by about 18 points when trade gets underway in less than a minute. Stay with us. I'll take you through the open next.